Hi folks, David Waring here again with InformedTrades.com in today's lesson of the day. In our last lesson we looked at how, in my opinion, traders who have an understanding of both technical and fundamental analysis are in the best position to be able to trade profitably. In today's lesson we're going to continue our free Forex trading course with a review of what we've learned up to this point, so we can make sure that everyone has an understanding of the basics which they're going to need throughout the rest of this course. So let's get started.
As we now have a basic understanding of how trade flows and capital flows move the Forex market, the next step is to look at each of the individual currencies we will be focusing on so we can gain an understanding of their backgrounds and the makeup of their economies. Once we have an understanding of this, it will become clear what fundamental factors are the most important drivers for each of the individual currencies, and therefore what we as traders should watch for. Before we get into this, however, it is very important that everyone has a sound understanding of how trade flows and capital flows move the Forex market, which is covered in Module 3 of this course, as well as the following concepts, all of which are covered in Module 8 of our free Basics of Trading course located in the free course section of InformedTrades.com. We all need to have an understanding of what the business cycle is, the difference between monetary and fiscal policy, what a central bank is and how they go about changing interest rates. In Module 8 of the Basics of Trading course, we cover the Federal Reserve, which is the central bank of the United States. While the central banks that we are going to be covering going forward may differ in how aggressive they are with monetary policy in relation to the Federal Reserve, the methods that they use to conduct monetary policy and the reactions of the Forex market that monetary policy generates is generally the same no matter what central bank you're looking at. The first currency we will be covering is the US dollar, so you should have a good understanding of the basic components of the US economy. I'm going to give everyone 10 questions here that you should now have a knowledge of and can answer if you've been through Module 8 of my Basics of Trading course and Module 3 of this course. To help make it interesting for everyone, I'm going to offer a free copy of Kathy Lean's excellent book, Day Trading the Currency Market, to the first person that posts the correct answers to all 10 questions in the comment section of this lesson on InformedTrades.com. If you're watching this video on YouTube, you can find a link to this lesson on Informed Trades to the right of this video. Okay, so here we go. Number 1, if inflation is low and a central bank is concerned about recession, what would the expected monetary policy response be, if any? Number 2, if inflation and growth are both high, what would the expected monetary policy response be? Number 3, if a central bank raises interest rates, what effect, if any, is this expected to have on the currency of that country, all else being equal? Number 4, if a central bank lowers interest rates, what effect, if any, is this expected to have on the currency of that country, all else being equal? Number 5, if a country's imports grow and all other trade and capital flows remain equal, what effect would this have on the current account, and what would be the expected effect on the currency, if any? Number 6, if a country's exports grow and all other trade and capital flows remain equal, what effect would this have on the current account, and what would the expected effect be on the currency, if any? Number 7, if a country is a major exporter of gold and the price of gold moves up by 50% over the course of a year, what would be the expected effect, if any, on that country's currency, all else being equal? Number 8, Japan is a major importer of oil and Canada is a major exporter of oil. If the price of oil goes up by 50% over the course of a year, then what effect, if any, should this have on the Canadian dollar-Japanese yen currency pair, all else being equal? Number 9, traders who follow the US dollar fundamentals, pay particular attention to any numbers which reflect the health of the U.S. consumer. Why is this? Number 10. The U.S. economy in the past was referred to as an industrial economy. Now it is referred to more as a blank economy. Fill in the blank there. Once the first person posts the right answers to all 10 questions, I'll send a private message to them via the forum to request the mailing address where they would like their free copy of Day Trading the Currency Market sent. That's our lesson for today. In tomorrow's lesson, we'll begin a discussion on the fundamentals that move each of the main currencies we will be focusing on, starting with the U.S. dollar. So I hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comment section below. And good luck with your trading.